All right, let's talk about monetary policy. Now, I know that sounds kind of dry, but stick with me here. It's this invisible force, this hidden hand, that's basically acting like the accelerator and the brake for our entire economy. And believe me, it affects everything, from your mortgage payment to the price of milk. Ever see the news and hear interest rates are going up and wonder, why? What's the point? Well, that's exactly what we're digging into, because it has a huge and direct impact on your wallet. Okay, so here's how we're going to break it all down. We'll look at the big balancing act the economy faces, check out the central bank's toolkit, talk about those accelerator and brake pedals, see what happens when things go wrong, and most importantly, connect it all back to you. First up, let's talk about the economy's balancing act. And really, the main character in this story is the Bank of Canada and its fundamental mission. So, when we say monetary policy, what are we actually talking about? Well, at its core, it's just the set of actions the Bank of Canada takes to manage the amount of money out there and to guide interest rates. The whole point is to try and steer our economy in a healthy direction. And what's that healthy direction look like? It's really this tricky juggling act. The bank is trying to keep four big things in balance: keeping prices stable, so your dollar is worth a dollar tomorrow, making sure as many people as possible have jobs, keeping our financial system from going off the rails, and of course, promoting steady economic growth. Okay, so that's the what. But how does the bank actually do all this? Let's pop the hood and take a look at its toolkit. Now, they have a few different tools they can use, but the big one, the main event, is the interest rate. It's like the master lever. Just by nudging this one thing up or down, they can send these massive ripple effects through the whole economy. So how do they pull that lever? Let's say they want to lower interest rates. It's actually a pretty cool chain reaction. First, the Bank of Canada goes out and buys things like government bonds from the big commercial banks. Step two, this move pumps a whole bunch of new cash into the banking system. And finally, when banks are suddenly flush with cash, they have more money to lend out. So they start competing with each other to get your business, and they do that by, you guessed it, lowering interest rates. And this is where we get to my favorite way of thinking about this whole thing: the economy as a car. And the Bank of Canada? Well, they're in the driver's seat, with their foot hovering over the accelerator and the brake. So this really gives the driver two basic moves. If the economy is sputtering and slow, in a recession, they stomp on the accelerator. They lower interest rates to get people and businesses spending again. But if the economy is running way too hot, causing prices to spike everywhere, that's inflation, they hit the brakes. They raise interest rates to cool things down. So let's talk about that accelerator for a second. How does it work in the real world? Well, when interest rates are low, it suddenly gets cheaper for you to borrow money for a new car or get a mortgage on a home. And it's the same for businesses. It becomes a great time for them to invest in new equipment, expand their operations, and hire more people. All of that new spending is what gets the economic engine revving. But here's the thing, this is not a perfect science, not even close. So what happens when the tools don't work as planned or when they misfire? Probably the single biggest challenge is timing. Think about it. The bank is making huge decisions today based on economic data that might be from last month or even the month before. It's literally like trying to drive a car forward while only looking in the rearview mirror. If they hit the gas too late to fight a slowdown, they could end up overdoing it just as the economy is picking up on its own, which can cause a whole new set of problems like runaway inflation. And if you want a perfect example of this, look no further than the 2007-2009 financial crisis. That was the ultimate stress test. The entire global economy was in a free fall. So what did central banks do? They slammed their foot on the accelerator, cutting interest rates like crazy. But then, a huge problem. Rates hit zero, and the economy was still stuck in the mud. Their main tool was completely tapped out. There's actually a name for this scary situation. It's called a liquidity trap. It's when the accelerator pedal is pushed all the way to the floor, but the car just isn't moving. Even with money being practically free to borrow, everyone is just too scared. Banks are scared to lend, and people are too scared to spend. The system just freezes up. So this is when central banks had to dig deep into their toolbox and get really creative. They rolled out these so-called unconventional tools, the most famous one being quantitative easing, or QE for short. You can think of it as a different way of getting money into the system. Instead of just focusing on interest rates, they started buying up all sorts of other assets to try and force-feed cash into the economy and get things moving again. Okay, so we've been through a lot of theory here. Let's get down to brass tacks. What does any of this, the Bank of Canada, interest rates, QE, What does it have to do with your everyday life? Well, pretty much everything. The decisions made by the Bank of Canada directly impact the interest rate you pay on your mortgage. They affect the cost of your car loan. They even determine how much you earn, or let's be honest, how little you earn on the money in your savings account. When they fight inflation, they're deciding how much your groceries will cost next month. And when they focus on employment, it can literally mean the difference between a hot job market and a tough one. So, if we boil it all down, what are the big takeaways? First, the Bank of Canada's whole job is to be the economy's stabilizer. Second, their number one tool is the interest rate. Third, remember the car analogy? Lower rates are the accelerator for a slow economy, and higher rates are the brake for an overheating one. And finally, and this is crucial, it's a really, really tough balancing act. It is not an exact science at all. And that really leaves us with a huge question as we look to the future. We live in a world with all sorts of new challenges, right? Global pandemics, massive supply chain disruptions, things our old models didn't account for. So the question is, are the tools that worked for the last 50 years still going to be enough for the next 50? Something to think about. Thanks for tuning in.